Two men, same administration, same morning, completely opposite messages about the same war. Trump told CBS News he believes the Iran conflict is, and I'm quoting him directly, very complete, pretty much. Called it an excursion, suggested it is almost over. His own defense secretary, Pete Hegseth, walked to the Pentagon podium hours later and said something that should stop every single silver investor cold. Today will be, yet again, our most intense day of strikes inside Iran. The most fighters, the most bombers, the most strikes, intelligence more refined and better than ever. The most intense day yet. On day 11 of a war that was supposed to last 3 to 8 weeks. Trump says almost over. Hegseth says most intense day yet. Both of them said it on the same morning. And while that contradiction was playing out across every news ticker in America, silver jumped from $83.96 to $88 in a single session. Gold pushed above $5,200. The world's largest oil refinery in the UAE just caught fire after a drone strike and shut down completely. And 6.7 million barrels per day of Gulf oil production, 1/3 of total Gulf output, has now been cut because the Strait of Hormuz is still effectively closed. This is not just a silver story. This is not an oil story. This is not even really a war story. This is the story of a contradiction at the center of the most consequential geopolitical event of the decade, and what that contradiction means for every person holding silver right now, because one of those two men is managing market psychology, and one of them is describing military reality. Those are not the same job. And historically, when that gap has appeared between political messaging and military operational tempo, markets eventually price the military reality, not the press conference. Let me show you exactly what is happening right now, because the data coming out of this conflict in the last 24 hours is unlike anything we have seen in this silver run. And understanding it completely changes how you read every price move from here. Start with what is on the ground right now. Not what the press conference said, what actually happened today. This morning, while Hegseth was walking to the podium to announce the most intense strike day yet, Iran fired a wave of drones and ballistic missiles at the Gulf states. The UAE intercepted 8 ballistic missiles and 26 drones on Tuesday alone. That is not degraded capability. That is an adapted, evolving threat. One got through. The Ruwais Industrial Complex in Abu Dhabi, home to the largest single-site oil refinery in the Middle East, caught fire after a direct drone strike. The refinery processes 922,000 barrels of crude oil per day. Abu Dhabi National Oil Company shut it down completely as a precautionary measure. Bloomberg confirmed the shutdown. Reuters confirmed the shutdown. The refinery that processes nearly 1 million barrels a day is offline, and that is just today. Saudi Arabia shut its largest refinery last week. Qatar closed the world's biggest LNG export facility the week before. Now the UAE's only refinery is down. 3 of the most critical energy processing facilities on the planet offline in the span of 11 days. Meanwhile, the Strait of Hormuz, the 21-mile waterway that carries 20% of global oil supply, has effectively zero commercial tanker traffic. Not reduced traffic, effectively zero. Only Iran-linked vessels and ships claiming to be Chinese-owned have been seen transiting. Every major insurance underwriter, Guard, Lloyd's, Skuld, the London P&I Club, has canceled war risk coverage. Without insurance, ships cannot move. It is that simple. Here is what that is doing to the producers themselves. Saudi Arabia, the UAE, Kuwait, and Iraq have now collectively cut oil production by 6.7 million barrels per day. That is 1/3 of total Gulf output, gone. Iraq's production is down 60%, from 4.3 million barrels per day to 1.7 million. Kuwait declared force majeure. Qatar already halted gas production on March 2nd and declared force majeure on gas contracts March 4th. The Qatari energy minister said publicly, and I want you to hear this, if the war continues, other Gulf energy producers may be forced to halt exports entirely, and this will bring down economies of the world. That is not a silver analyst. That is the energy minister of Qatar. And Trump said the war is almost over on the same morning Hegseth announced the most intense strike day yet. Now you understand the contradiction. Now let me show you exactly why silver, specifically silver, sits at the precise intersection of every force this contradiction is generating. Silver just moved from $83 to $88 in approximately 24 hours, driven by 2 forces that almost never point the same direction simultaneously. Force 1 is safe haven demand. When the future is genuinely uncertain, when a president and his defense secretary cannot agree on whether a war is ending or escalating, institutional capital moves into hard assets. Gold and silver absorb that flight. The Trump-Hegseth contradiction is maximum uncertainty. Nobody knows what happens next. When nobody knows, physical stores of value attract capital that has nowhere else certain to go. Force 2 is dollar weakness. The DXY was trading at 99.42 during Asian hours. under pressure as investors grew cautious that a prolonged conflict would disrupt global energy and weigh on global growth. Every full point the dollar index falls adds $2 to $3 to silver purely through currency math, not through any supply or demand change, pure arithmetic that runs automatically. Both forces are operating simultaneously right now. Safe haven bid pushing silver up, dollar weakness pushing silver up. When those two forces align, silver moves faster than gold. It always has. The volatility that makes silver feel risky on the downside is the same volatility that makes it move harder and faster than gold when both tailwinds are blowing. And underneath both of those forces, the structural picture that existed before February 28th has not changed by a single data point. The sixth consecutive annual silver supply deficit is running, approaching 200 million ounces for 2026. Global mine production has been flat for 5 years at roughly 830 million ounces per year. Industrial demand has crossed 1 billion ounces per year and is climbing. The math produces a structural deficit that exists completely independently of what happens in Iran. COMEX registered silver, the metal available for physical delivery, continues draining. The March delivery cycle committed over 60% of registered inventory in a single contract cycle. Physical silver dealers are currently charging $6 to $8 over spot. At $88 spot, the real-world cost of an ounce of silver entering your possession is $94 to $96. The paper market says $88. The physical market charges $94 to $96. That gap is the physical market broadcasting supply stress that the paper price has not fully caught up to yet. Now here is the piece that most silver coverage completely misses. The Hormuz crisis is not just a geopolitical event for silver. It is a direct and permanent repricing of silver's production cost floor. Silver mining runs on energy. Diesel, electricity, explosives, all priced off oil. At $70 oil, where we were 18 months ago, the energy component of mining 1 ounce of silver runs roughly $8 to $12 per ounce. Brent crude hit $120 per barrel in Tuesday's session. At $120 oil, that same energy component runs $18 to $20 per ounce. That is not a temporary premium. That is a structural upward shift in the cost required to pull silver out of the ground. Every week oil stays elevated, the production cost floor for silver moves up permanently. Miners do not cut prices when energy costs fall. They keep margins. But when energy costs rise, the cost floor rises with them and stays there. The market has not fully priced that repricing yet. The paper silver market is still reacting to the geopolitical headline. The production cost structural shift is a slower moving but more permanent force underneath it. Now, let me give you the complete scenario picture. Not predictions, the actual structural scenarios that the data currently supports and what each one historically implies for silver. Scenario 1, the ceasefire path. Trump is right in a way that Hegseth's posture does not yet reflect. A diplomatic channel through Qatar, Oman, or a Chinese intermediary produces a face-saving framework for Iran's new supreme leader. The conflict ends faster than the military timeline suggests. Insurance underwriters begin reinstating war risk coverage over weeks. Oil retreats from $120 toward $90 to $100 as Hormuz gradually reopens. In this scenario, silver's acute geopolitical bid softens. The paper price retreats toward the $84 support level. Whether it holds that level depends on whether the structural bid, the deficit, the vault drain, the physical premium, absorbs the geopolitical unwind or not. Here is what history suggests on that specific question. When geopolitical premiums unwind from precious metals, the structural backdrop determines how much of the retreat gets absorbed. In 2022, the Russia-Ukraine silver spike fully reversed, because the structural deficit was in year 1. In 2023, the banking crisis silver spike partially reversed. Deficit was in year 3. Right now, the structural deficit is in year 6, the deepest and most sustained in the modern silver market. The structural absorption of a geopolitical unwind may be meaningfully stronger this cycle than in any prior episode. The data does not guarantee that. But that is what the structural comparison shows. Scenario 2, the extended conflict path. Hegseth's posture proves more accurate than Trump's messaging. The war extends through weeks 3, 4, 5. Iran continues proxy operations, Houthi networks, Iraqi militias, Hezbollah channels, even as its direct missile capability degrades. The Hormuz insurance blockade persists. Oil holds above $100. The dollar stays under pressure as global growth fears compound. In this scenario, the gold-silver ratio becomes the key data point. The ratio currently sits at 58, meaning 1 ounce of gold buys 58 ounces of silver. During sustained periods of dollar weakness combined with industrial demand stress, this ratio has historically compressed, meaning silver outperforms gold in both speed and magnitude. The ratio compressing from 58 toward 50 to 52 would imply silver outperforming gold from current levels, even if gold itself does not move significantly higher. Every session Hormuz stays closed in this scenario adds permanent pressure to the production cost floor. Every session oil holds elevated adds another dollar to the structural floor under silver's cost of production. The geopolitical premium and the structural premium begin to compound rather than operate separately. Scenario 3, the expansion path. This is the scenario that no mainstream outlet is spending enough time on, and it is the one the data is most quietly pointing toward. Iran's new supreme leader, Mojtaba Khamenei, son of the killed supreme leader, was named over the weekend. He is described by every intelligence assessment as an IRGC hardliner. Trump told Fox News he is not happy about the selection. The CIA's assessment going in was that an IRGC hardliner would replace Khamenei if he was killed. That assessment was correct. The regime did not moderate in response to losing its leader. It hardened. This morning's drone saturation attack on the UAE, while Hegseth was announcing the most intense strike day yet, is not the behavior of a side preparing to negotiate. It is the behavior of a side adapting its tactics and absorbing the military degradation while looking for leverage points elsewhere. If the conflict expands, Hezbollah activating a northern front, Houthi operations intensifying in Yemen, Iraqi militia attacks on U.S. bases escalating, the regional calculus shifts entirely. The safe haven bid for precious metals accelerates. The dollar comes under sustained pressure as confidence in U.S. fiscal management during an expanded regional war erodes. The Federal Reserve, already trapped between 4.4% unemployment and 3.8% wage inflation with $120 oil, faces a stagflation scenario with no clean exit. This is where the 1973 to 1980 historical framework becomes most relevant, not as a prediction, as a reference point for understanding what sustained energy-driven inflation has historically done to silver over a cycle. In 1973, the Arab oil embargo sent oil from $3 to $12 per barrel. Silver was $2.56 an ounce. By 1980, silver hit $50. That is a 19-fold move. The oil shock did not directly cause the silver move, but it triggered the inflationary cycle that made hard assets the only reliable store of value for 7 years. The structural conditions today share more similarities with that setup than any period in between. The exact outcome cannot be known in advance, but that is the historical reference frame the data is pointing toward when these forces align. Now, I want to talk directly to you, because depending on where you are right now in the silver market, today looks very different. If you have been holding silver since 2024 or early 2025, you're sitting on significant gains even after the corrections. The $56 entry in October 2025, the $70 at year end, the $75 in January. All of those are up meaningfully at $88. The question for you is not whether the thesis worked. It did. The question is whether you understand the structure well enough to hold through what will almost certainly be volatile sessions ahead, regardless of which scenario develops. Here is what the data says about holding through volatility in a structural precious metals market. The 2025 full-year gain in silver was 141.44%. Within that gain, there were multiple sessions where silver fell 5 to 10% in a single day. Multiple sessions where social media declared the run finished. Every single one of those sessions was followed by a structural recovery, not in a straight line, not immediately, but structurally. The investors who captured the 141% gain were not the ones who timed every session. They were the ones who understood why they owned silver well enough to hold through the sessions that felt like the end. If you are watching silver but have not yet positioned, the picture is different for you. Silver at $88. The technical levels are closer in percentage terms. The $84 support is 4.5% below current spot. The $73 level is 17% below. Position sizing that genuinely accounts for those levels, not optimistically assuming they hold, but stress testing whether you can tolerate them if they do not, is the difference between a position you manage rationally and one that forces a panic decision at exactly the wrong moment. Nobody can tell you what the right entry is for your specific situation. And what the data can tell you is what the structural and technical backdrop looks like right now. Everything else depends on your time horizon, your existing exposure, and your understanding of why silver specifically makes sense in a portfolio like yours. Now the 4 signals that will tell you which scenario is developing before any mainstream headline catches it. Signal 1, Trump's next statement on Iran war timeline. Watch specifically for whether he backs away from very complete, pretty much, and aligns with Hegseth's escalation framing, or doubles down on ceasefire messaging and produces a visible diplomatic track. One of those 2 things happens next. Which one tells you whether political messaging or military reality is winning the internal battle? Signal 2, Hormuz insurance status. The financial blockade, not the military one, is what is keeping oil above $100 and silver structurally supported. Watch for any announcement from Guard, Lloyd's, Skuld, or the London P&I Club on war risk coverage reinstatement. Even partial reinstatement signals the energy cost premium beginning to moderate. No reinstatement signals. It stays embedded permanently in production costs. Signal 3, silver's behavior at $91 to $92. Technical analysts have identified a daily close above $91 to $92 as the breakout confirmation for the next structural leg. Silver is currently at $88. A move through $92 on meaningful volume with a close above it is the chart structure validating the move. Watch how price behaves specifically at that level, whether it finds buyers or sellers. Signal 4, the DXY direction. The dollar index has been trading without clear direction, which is structurally bullish for silver by default. A confirmed daily close below 97 removes the mechanical currency headwind on silver entirely. A sudden surge above 99, particularly on a peace deal announcement, signals the safe haven dollar trade returning and silver's near-term currency tailwind reversing. 4 signals: presidential messaging alignment, Hormuz insurance, silver at $91 to $92, DXY. Most people watching silver right now are watching a number on their screen. You're now watching the 4 mechanisms that move before the number does. Here is what is happening right now, in real time, while you're watching this. A president told CBS News the war is very complete, pretty much. His defense secretary announced the most intense strike day of the entire operation 1 hour later. Iran fired 8 ballistic missiles and 26 drones at the UAE on the same morning. One hit the largest oil refinery in the Middle East. That refinery, 922,000 barrels per day, is now offline. Saudi Arabia, Kuwait, UAE, and Iraq have collectively cut 6.7 million barrels per day of production because the Strait of Hormuz has had effectively zero commercial traffic for 11 days. Brent crude hit $120. The physical silver market is charging $94 to $96 per ounce, while the paper market prints $88. And Iran's new supreme leader is an IRGC hardliner that every intelligence assessment said would never negotiate. All of that is happening simultaneously, right now, in the same 24 hours. The resolution of the contradiction at the center of all of it, which man is right, Trump or Hegseth, is the single most important unknown in the precious metals market at this moment. And it is going to resolve one way or the other before most people watching silver realize it already has. That is the market you are navigating. The structural picture is clear, the scenarios are clear, and the 4 signals tell you what to watch before the price moves. If you find these silver market breakdowns useful and want to support the research behind this channel, you can use the thanks button below the video. I appreciate everyone who supports the work. Subscribe if you want to stay inside the data as this unfolds, because this story is not finished, and the next chapter will not arrive with a warning.